Intertek's board rejected EQT 3 times, and then, on May 13th, it did not, and the price it accepted was the same £60 a share it had already walked away from. That asymmetry is the analytical entry point. A board does not reverse on price. It reverses on pressure, and the pressure here was named explicitly as significant shareholder engagement in the board's own statement. That phrasing is not diplomatic filler. Under UK Takeover Code convention, boards do not invoke shareholder sentiment to explain a recommendation unless that sentiment was the proximate cause. The capital was already positioned against the board's resistance. The 6.8% single-day move to 5,662.50 reflects the market repricing the probability of deal completion, not the value of the company. Before May 13th, the spread between the prevailing share price and the £60 offer embedded deal failure risk. The board's capitulation compressed that spread in one session. But the compression happened at 5,662.50, still below the £60 offer price, which means the market is not treating completion as certain, even now. What forces the next question is this. If shareholders drove the board to reverse, they must have already accumulated enough weight to make resistance untenable. That concentration of shareholder pressure does not dissipate after a board recommendation. It converts into votes, and votes are what determine whether EQT's firm offer, if filed by June 11, actually clears. The board's U-turn is therefore not the resolution of this event. It is the opening condition of the next test, which is whether the shareholder bloc that forced capitulation holds together long enough to deliver the outcome EQT needs by the takeover panel's deadline. Norges Bank's Rule 8.3 disclosure on May 14th, the day after the board greenlighted the bid, reveals a 1.70% stake held as of May 13th, the exact date of the board's decision, and that coincidence of timing is where the analysis pivots. Rule 8.3 filings are mandatory for any holder crossing 1% during a live offer, but the filing date can trail the position date by up to a day. Norges Bank did not acquire on May 14th. It held on May 13th, meaning the position was built before or during the period of maximum board resistance. A sovereign wealth fund at 1.70% is not a passive index overweight. At that size, in a live takeover situation under the Takeover Code, it is a declared participant whose vote matters to the offer's outcome. The counter-signal worth examining here, RBC cut its recommendation on Intertek immediately after the bid announcement. A downgrade concurrent with a rising share price typically signals that the analyst views the current price as adequately reflecting the outcome probability. In other words, the upside from here requires deal completion, not fundamental re-rating. RBC's cut does not challenge the deal logic. It challenges the risk-adjusted entry for anyone not already positioned. What Norges Bank's disclosure does not answer is whether it was positioned in favor of the deal or simply caught inside the mandatory disclosure perimeter. That distinction matters because if Norges Bank is a swing voter, its ultimate vote stance, not just its disclosed stake, becomes a condition on which the June 11th deadline either becomes a firm offer announcement or collapses back into an extended bid clock. Vanguard's concurrent 8.3 disclosure adds a second major institutional name to the live register, and two large passive-leaning holders on the Takeover Code register simultaneously shifts the question of deal approval from the board to the institutional assembly, which is exactly where it should have been from the first rejected offer. The deeper valuation signal in the Intertek situation is not company-specific. It is that private equity is now systematically pricing testing and certification infrastructure above what public markets are willing to hold it. EQT, backed by the Wallenberg family, is paying a control premium into a sector that Bureau Veritas and SGS also occupy, and all three businesses share the same structural characteristic: contract recurring revenue tied to mandatory compliance testing, which in private equity underwriting reads as infrastructure-grade cash flow with a regulatory moat. Public markets have historically discounted this cash flow against growth sector alternatives. Private equity is now arbitraging that discount. As a supporting case, Intertek would become the third FTSE 100 company taken private by foreign buyers in 2026 if the deal closes, a data point that does not describe Intertek's idiosyncratic risk, but does describe the systemic repricing of London-listed assets. The premium EQT is paying at £60 per share establishes a reference valuation for the peer group that Bureau Veritas and SGS holders now sit against, whether or not those companies receive approaches. The condition that would resolve whether this sector repricing continues, EQT filing a firm offer before June 11. If the firm offer is filed, the £60 benchmark becomes a closed transaction price and sector peers re-rate toward it. If EQT extends or withdraws, the benchmark collapses back to a rejected bid, and the discount the public market applies to testing and certification assets widens rather than narrows, because the arbitrage that PE identified would have failed at the point of execution, which is the one test that matters. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.